The budget was presented in a very interesting context of the 14th Finance Commission, which has recommended the devolution of 42% of central tax revenues to the states. This compares to a 32% the year before. What that means is a much higher share of revenue now goes to the states than the center. In this context, it is quite admirable that the government has managed to restrict its fiscal deficit for the year 15-16 to 3.9% of GDP or 5.5 lakh crores as against an initial budget of 5.3 lakh crores, 4.1% of GDP for the current financial year 14-15. Not only is the 15-16 budget estimate now going to be 3.9% of GDP, but for the following year, the fiscal deficit is likely to be 3.6% of GDP. These two numbers, the deficits for the next 2 years of 3.9% and 3.5% compared to an earlier target of 3.6% and 3% respectively. The higher fiscal deficit is going to be pro-growth, which is as stated by the finance minister. How does this impact the bond markets? Now we know that the Reserve Bank of India has pointed to two major factors driving its interest rate decisions. The first is the pace of disinflation or the fall in the CPI inflation. Now CPI inflation is at 5.1%, which is well within the RBi's 6% upper limit. Therefore, the RBI has started the rate cut process. The second impact from the RBI's perspective is the trajectory of fiscal deficit. Now, of course, under the new regime, it is likely that the fiscal deficit is going to be slightly higher than the erstwhile plan. But because a large part of this increase in the centre's fiscal deficit is on account of devolution to states, the states will have a correspondingly lower deficit. Therefore, the general government deficit is not expected to substantially increase. This should allow the Reserve Bank to cut rates going forward. The pace of rate cuts will depend on the RBI's reading of this budget, which we will know in about a month's time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.